What's up everybody, Nate here, and 2024 is already shaping up to be an insane year, coming off of a 2023 that was even crazier. In 2023, we saw unemployment start to rise again. We also saw really high inflation and really high interest rates at the same time, not to mention the bridge between the rich and the poor effectively got a whole lot wider. That has led a lot of people to wonder if in 2024 this bridge is going to get even wider, and are we going to see a recession sometime this year? Now, when we talk about recessions, things get a little bit complicated. Like, we have to first define what a recession actually is. Now, there are a variety of different ways that economists and experts and investors like to define recessions. You can look at the amount of income people make every single year. Is that number going up? That leads to affordability. Can people afford more things? Because if they can't, well, then they're going to be able to buy less. That puts less money into the economy. So experts can look at affordability and incomes and decide if the United States is headed into recession territory. So like I said, there are a lot of different ways to define what a recession actually is, but typically when we talk about recessions, then what we're actually trying to say is that the US economy is in a downturn, which basically means that there is a lot less going on and there's a lot less economic prosperity. People aren't making as much, things are costing a lot more, and businesses are not doing as well. There aren't as many people employed, and there's just not as much money to create wealth opportunities in the United States. Generally though, 2 consecutive quarters of economic shrinkage or decline in a country's GDP typically means that you are in a recession. Now, the crazy thing about this is we actually saw this not too long ago. GDP is basically the output of the country, so it's our gross domestic product. It's every single thing that every single business makes. How much did they sell all of that for? How much did all of that go out for? This is basically a measure of how much we're actually producing, and if that number is going up, then your economy is healthy, right? Because that means that there's a demand on a global scale for all of the things that the United States produces. So you want your GDP to go up, but at the beginning of 2020, we actually did see our GDP decline for 2 consecutive quarters, which meant we were in a recession. We actually even saw GDP begin to shrink at the beginning of this year in Q2 of 2023, but most economists agree that right now, based on all metrics, we are not in a recession in the United States. So if we're not in a recession right now, then when is the next recession going to be? Are we going to see a recession in 2024? Now, there are a variety of different metrics that we can look at and sort of use to predict if we're going to be in a recession in 2024. The first thing I want to talk about comes to CEOs, and particularly what businesses are saying about a recession next year. The vast majority of CEOs are predicting that the United States is going to see some type of recession next year. In fact, around 90% of CEOs, and this is for private businesses and public businesses, are predicting some type of recession. Now, why exactly are they saying this, and why exactly does this matter? Well, businesses in the United States, they sell things, and what that means is they have a little bit of a different insight of what consumer spending is going to be and what demand is going to look like. So take a business like Walmart or take a business like McDonald's, right? So they are able to track what consumers are spending because these businesses are staples of our economy. So if people are not spending as much money at Walmart, if they're not spending as much at McDonald's, then that means there could be a general pullback in consumer spending. And if there is a general pullback in consumer spending, those businesses are going to have less money, which could ultimately lead to layoffs. And if people are laid off, then they're not going to have as much money to go out and buy things, which means even less money flowing into businesses and less money going around our economy. Just in general, people are going to be a little bit more frugal and have to decide on what they're going to spend their money on. Are they going to spend their money on just necessities? And what exactly does just necessities mean for each individual family? Or do people have a little bit more spending money and are going out and buying things that they don't necessarily need, that they just want? So if you see spending going up, then recession might not be happening. But with businesses essentially saying that they believe consumer spending and confidence may end up going down in the future, then that could potentially mean a recession around the corner, simply because people aren't spending as much money. What you can also start to see is a lot of the the earnings reports on Wall Street. So not only do the CEOs believe that consumer spending is going down, but they're also reporting numbers like consumer spending is actually going down because profits are beginning to fall too. Most of your larger businesses right now, like Amazon and Walmart and even Starbucks, have reported in recent months that consumer spending has been pretty decent and their revenue streams and their profit are remaining strong. So that has not indicated that a recession is coming in 2024. It is showing that consumers are feeling very resilient and there has been a lot of pent-up demand for people shopping, especially as inflation has come down and incomes have gone up over the last year or year and a half or so. So that has meant that people have been buying more, but the sentiment still remains from a lot of CEOs that the amount that people are spending right now probably isn't going to continue into next year. They don't know for sure because they can't predict the future of 100%. They can use certain factors like their earnings and their sentiment and what is going on in the industry to sort of predict things, but at the end of the day, they don't know 100%. So from the business side and the CEO side, a lot of them are predicting, yes, there could potentially be a recession in 2024. Number two, certain markets tend to go up right around the time that the United States is going to face a recession. One in particular is the gold market. Investors like to buy gold because it has a universal store of value, and what that means is that even in an economic decline, even when other assets like stocks and bonds tend to lose value, gold tends to go up in value, especially during times of high inflation, because it is still seen as valuable. And the reason being is because it is physical. It takes time, money, and energy to actually create an ounce of gold, which gives it that inherent value over a paper asset and over our paper money, right? So investors like to go towards gold when they feel like the dollar is going to lose value or other markets and businesses are going to start losing value and the price of those assets are going to go way down. So investors will put their money in gold. And what have we seen over the last 6 months or so? The price of gold goes steadily higher. Gold actually hit a record high in December of 2023 because investors are starting to predict that potentially we could see a recession in 2024. Gold prices have gone up during times of economic stress before. Like at the start of the pandemic, we saw gold prices hit a record high during that time because investors were worried that inflation was going to be very high. They didn't really have a lot of confidence in the stock market or other markets and values were going down. So investors wanted to put their money into something that was going to continue to be valuable even if other markets were going to have a lot of issues. So investors bought a lot of gold during that time to protect themselves and their wealth and their assets. You can see the same thing happen during other times of economic stress and recessions in the United States. We can see this during the 2008 Great Recession and the dot-com bubble and throughout the 90s when we had recessions. Typically, the price of gold goes up. Now, the price of gold doesn't go up all the time. The price of gold typically will fluctuate based on what investors can get in terms of a return. If investors feel like markets are doing really well and the future is looking very bright for the US dollar and things like, say, the stock market, then they could get a higher return by investing in stocks, and those might be a lot less risky of an investment for them at that time. So if that's the case, then investors are going to buy more stocks, and if they buy more stocks and the price of gold goes down because there's just less people buying gold. Simply put, there's only so much gold out there. So if investors are buying more gold and there's a limited supply of it, the price goes up. Versus if they're buying a lot more stocks, then there's a lot more gold out there and there's less people that want it. So that means the price ultimately is going to go down. That happens after a recession already happens because now you have a lot more stimulus measures and you have a lot more money sort of pumping back into the economy to try to get the country out of the recession that it is currently in. So basically, when you see the price of gold start to go up, well, that could indicate that a lot of experts and investors are losing confidence in the US dollar. And another thing that we can look at is Fitch and Moody's essentially downgrading the United States' credit rating. So these organizations basically give the United States and other countries a credit rating to allow businesses and other governments to borrow money from them to show how safe and how strong of an investment that is going to be. But the United States got a downgrade downgrade, and Moody's is talking about giving the United States a downgrade as well. But they believe that the strength of our economy isn't as strong as it might have been a few years ago because we have been facing a lot more economic shutdowns. And also, the United States debt is getting a lot higher, and it's pretty unreasonable that the United States is going to pay it off, meaning if people continue to borrow our money, what happens if the United States crashes? That sort of builds the case for this gold, right? So now if everybody's holding on to US dollars and the US dollars suddenly lose all of their value, now gold becomes a lot more valuable. So people are sort of predicting by buying gold that the United States is going to be facing some issues in 2024. That's why gold has hit a record high. Now, on a slightly more positive note, the other thing that you can look at is Treasury bonds. So Treasury bonds are something that investors buy because they are seen as one of the most risk-free assets out there, meaning they are virtually completely safe to invest in because you're always going to get back some sort of return. The return on Treasury bond is called a yield, and yield prices typically have an inverse relationship with Federal Reserve interest rates. When bond prices are really low, Federal Reserve interest rates are typically very high. When bond prices are really high, Federal Reserve interest rates are usually low. Now, where do you think we're at right now? Treasury yields had been going up to reach an almost 20-year high over the last few months. Now, they have slowly been coming down from those highs as investors have been searching for other sorts of assets to invest in, and that's where the positivity comes in. When you see investors buying a lot of Treasury bonds, well, that's because they are afraid of what could potentially happen in our economy, and the fear is there could be a recession coming around the corner. Treasury bonds are seen as such a safe asset because you are investing with the United States government. You're essentially loaning the United States government a bunch of money, and the US government is going to pay you back with interest. That is the yield that you get from that investment. If you see investors buying more bonds than anything else, well, that means they feel that they can get a better return from buying bonds than something like gold or the stock market, or a bunch of these other markets out there, right? Because they feel those markets could potentially go down, and it's a lot safer of a bet to put their money in Treasury bonds. With the Federal Reserve raising interest rates and inflation still really high and unemployment going up, investors were getting a little worried, and they started putting a lot of money into Treasury bonds, which pushed the 2-year and the 10-year yield to near 20-year highs. But then the Federal Reserve started talking about potentially cutting interest rates in 2024 and not raising interest rates any higher, which then sort of led a lot of investors to believe that our economy is doing a whole lot better than they thought previously. So now investors are starting to pile into the stock market once again, and real estate and all of these other markets, because they believe that they're going to get a higher return on those assets, and they should buy right now before prices could potentially go up the middle parts of 2024. So they believe that they're going to get a better return, and they believe that if the stock market is doing really well, then businesses are doing really well, which means our economy should be doing really well too, which means those yields are now starting to come down as investors are not buying as many Treasury bonds. So as far as some stock market investors are concerned, there is a less likelihood that we could see a recession, and if we do, it could be a very small recession like we saw in 2020. The last thing we have to talk about is the Federal Reserve. Now, the Federal Reserve has hinted that they're going to cut their interest rates in 2024 3 times. Now, over the last year and a half, the Federal Reserve has been raising their interest rates in order to fight inflation. And basically what that means is that they make their rates really high, which makes it really hard for people to borrow money. So you can't go to the bank and get a mortgage as easily or buy a car as easily because interest rates are really high. It disqualifies millions of people from getting a loan, including investors on Wall Street. That shrinks demand because people can't buy as much, and if people can't buy as much, demand goes down, and thus you have a lot less inflation. But that also creates a lot of other problems in your economy, because if people aren't buying as much, then that means businesses are going to suffer, and if businesses suffer, that creates unemployment, which makes even less demand, which could essentially throw your entire economy into a recession if interest rates go too high. So the Federal Reserve has been raising their interest rates, and now interest rates are at a near 20-year high. They're the highest they've been since around 2006. With interest rates this high, that creates a restrictive economy, and what they want to avoid is making the economy too restrictive. If the economy becomes too restricted, then nobody's able to buy anything. And now we kind of come to this idea of the Federal Reserve slashing or cutting their interest rates. If the Federal Reserve cuts their interest rates, then they have to have a reason to do so, right? The Federal Reserve doesn't just cut their interest rates or raise their interest rates for no reason. The Federal Reserve waited until inflation was already a big part of our economy before they started raising their interest rates. Chances are they're going to do the same with cutting their interest rates. They're going to wait until they see unemployment really start to ramp up, or businesses really start to suffer, or Americans really unable to buy things and housing prices effectively going in the gutter. Right now, we haven't really seen any of that. I mean, we have started to see unemployment going up, and we have started to see inflation come down, and the Federal Reserve has said until inflation hits around 2%, they're not going to cut their interest rates. Now, there's no guarantee that they're going to do that. It really just depends on other economic factors and where we are as an economy, because if other businesses are starting to struggle and Wall Street is struggling too, the Federal Reserve might have to step in, just like what they did at the start of the pandemic with quantitative easing. That's where they bought trillions of dollars worth of Treasury bonds and corporate bonds in order to stimulate our federal government spending and Wall Street spending. But if you see the Federal Reserve start to cut its interest rates, then that could mean that we literally are in a recession, because that is a stimulus measure, right? The Federal Reserve cutting interest rates allows people to go out and buy a bunch of things. It allows people to borrow a bunch of money. So if the Federal Reserve actually does cut its interest rates, then that means the economy is gonna get a whole lot worse before it starts getting better. Now, obviously, this is all just a theory, and don't take any of this as direct advice. I would never tell you what to do with your money. Never listen to random people online like me. But I think the overarching lesson here is to just be prepared, right? Because recessions are a part of our economy, and they're never going to go away, at least not anytime soon. Being prepared, though, helps you capitalize on investing opportunities and any opportunities that arise during a recession, or even if we don't see a recession, right? You are prepared because you understand how our economy works and you understand how markets work. And if you can put those two together with education, now it doesn't matter if we see a recession or not, because you understand how money works and you're going to be able to grow your wealth no matter what. We have seen booms and busts in our economy before. Like right after the Great Recession, we saw a huge boom in our economy. And of course, there was the Great Recession and the dot-com bubble, which were huge downturns in our economy too. More millionaires are created during recessions than any other time in history. And the reason for that is because understanding how recessions work and how money is allocated during those times allows you to capitalize on opportunities, meaning you can gather a whole lot more money when other people are more afraid than ever before, and you can capitalize on those opportunities. Or people are running on hype trains because they think they're going to make a whole lot of money fast, but you know a lot better than that. So the idea here is to just be prepared no matter what our economy throws at you. Like I said before, this is not investing advice. I would never tell you how to invest your money. Do what makes the most sense for you and your goals and your financial plan. I'm not an economist, so I can't tell you if we're going to see a recession or not in 2024, but what I can tell you is that being prepared is going to be your best bet, whether we see a recession or whether we don't. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.